Wondering how you can become better at running your business? Entrepreneurship can be stressful. There's too much to do and not enough time. If you're isolated in your daily decisions, have no fear. Success and balance are possible. Welcome to the Small Business Answer Man podcast, where you master the art of running a successful business using practical advice from experts who want to help you succeed. Now, here's your host, Gary Wilbers.
Welcome. We're glad to have you back again for another great podcast. I told you in this second quarter, my goal was to get different perspectives from different guests that would really share some information to help us as small business owners grow our business or maybe grow our income. So today, I think I found that guest again. So I think you're going to enjoy this conversation. So Stewart, would you share with our guest, what problem will you help them solve today?
I like to help small business owners solve the problem of generating passive income outside of their business.
I love talking about passive income. So you can see why I got excited about this conversation. So I want you to also, the listener, to get excited about it. Because today we've got with us Stewart Heath. He's a CPA. He's the CEO of Harvard Grace Capital, an extension of the Harvard Grace Corporation. Stewart has been a real estate investor for over 20 years, focusing on commercial real estate, including retail, self-storage, gymnastic facilities, and even medical offices. Stewart, it's great to have you on the podcast. Welcome.
Thank you so much, Gary. It's quite the honor. Thank you.
Well, we know we both love talking about passive income and having that conversation. And that's conversations I want to have with you. But I'm going to go back because, I always say in the podcast, you can't assume anything. So when somebody hears passive income, they may believe what they know it means, but others may not. So will you share with me what you believe passive income is and your definition of it?
Sure. I think the general definition of passive income is mailbox money. It's what a lot of people call it. Passive income is income that you will receive without having to lift a finger to generate that income, whether that be through buying an annuity or some other type of asset ownership. That income is going to come as long as you own that asset.
I love that. That's a great way to frame it up. And this should have perked up our business owners' ears because they work hard for the money they get today. And I always tell people when I'm coaching and working within my mastermind, I always talk about passive income. It's one of those things that you need to invest in other areas than just your primary business. And the reason for that is I believe it's kind of like a rainbow. There's a pot of gold at the end of that. The only problem is if all that pot of gold is the same thing and your business happens to fail because markets change, distribution channels, all those things that we don't know what could happen. You don't want all those eggs in one basket, or I like better gold in that basket in one basket. So we're going to talk about real estate and why that's so important. But let's start off because in your area, it's about real estate. And I think some people don't realize some of the true tax advantages and tax benefits that you can get in real estate. Can you share some of that background that you have there, Stewart?
Sure. Real estate stands out among investment alternatives in one way because of the tax benefits that you can get from the direct ownership of real estate. And I say direct because a lot of people will think that they're adding real estate to their investment portfolios when they own shares in a REIT, but those tax benefits do not flow through to you through the real estate investment trust. Direct ownership does not mean that you're directly managing it, but it means that you're a direct owner in an entity that owns the real estate, such as a limited partnership or an LLC, where you invest your money in that. Now, what are those tax benefits? For starters, it's depreciation. What is depreciation? That's generally called cost recovery. So you buy an asset for say $100,000, and the IRS lets you recover that $100,000 over an estimated lifetime. Most of us most business owners, I suspect, are familiar with this, and they're probably familiar with a Section 179 deduction, asset expensing in the year that you buy it. And you, over the years, you know, I am so old that that the that the year I came out of college, that the Section 179 deduction was limited to $20,000, and now it's been increased, I think, $450,000. But on top of that, the 2018 Act, it brought in bonus depreciation, which we've had on and off over the last 25 years. But this is the most aggressive that it's ever been. And right now in 2024, we're in a period of 60% bonus depreciation that's applied to personal property. Well, what's that got to do with real estate? Well, any operator of real estate that's worth their salt will do what's called a cost segregation study, whereas they will go through the process and figuring out what in that building can be reclassified as personal property. And this is all completely above board. And the IRS has actually issued a program of how to do it. So it's completely legal. So you're taking your 31 and a half year depreciable asset, and you're taking some of that and you're making it 5-year property. And once you do that, not only do you just get a shorter life of depreciation, but you'll get the opportunity to use bonus depreciation in the year that you buy it. So, and that's a big pop to you in the year that you get it. It'll help you offset other passive income, if not just the income that you get from the real estate. So that's number one. The other very attractive that a lot of real estate people don't talk about, but this is really what the politicians are talking about when they want to tax carried interest. Well, I think there's about 5% of the people in the world who knows what that means. Here's what that means. When you own a piece of real estate and that net operating income goes up year over year, it's worth more and more. If I want to pull cash out of that, I don't have to sell it. I go to the bank, I borrow as much money as I can from the bank, I pull that out. That's a tax-free transaction. And that's why the politicians want to tax carried interest. I don't think that has a chance of ever passing because we have a system that's built upon transactions, taxing something when it's been bought or sold, and that's a far field. But let's get back. That is a tax-free transaction to borrow against your asset, pull cash out, and your asset's still operating. It's going to pay off that new, bigger mortgage, and it'll still throw off cash flow to you every month. But you're just taking out a chunk now, and you can do that 4, 5, 6 times, depending on how long you own the asset. Probably not more frequently than 3 years, but it's just like owning your home when people do cash out refis for their home. So the other potentially big benefit of from taxes in real estate is the potential to do tax-free exchanges. So you own a property for 10 years. You might have a basis of it of 100,000. It's now worth $1 million. You can exchange that asset for another asset and on a tax-free basis. And this is something you cannot do with stocks and bonds and things of that nature. So real estate has an awful lot of tax advantages that you can't get with public market securities.
Yeah. Well, I really appreciate you sharing that, and you really broke it down well. The one that I'm going to come back to, because I'll be honest, I just learned about this, and I told you I've been investing in real estate since 1994, is the cost segregation. Because in some organizations and some, sorry, but CPAs, accountants don't give the people the right advice that they should. And I say that in a general terms, but I did not receive that. And this cost segregation, I don't think people understand that. So the one thing I want to do is, we don't have time to get details in there and stuff, but I want you to think about that, because if you buy an asset, just think, if your business is doing really well now, you invest some of that money that you have in your business that you made profit on, you've paid taxes on, but now you invest in that. Now you get a greater depreciation in for yourself in the company. And you can have that asset in an LLC or whatever that comes back, it flows back to you through your K1 or whichever way that you have it set up. But this is one that I think people really need to understand. So again, I'll let you, kind of, if you want to say a few things about it, but cost segregation, just make sure that you understand that. And if you have any resources, maybe to tell them to think about, go ahead and share that if you don't mind, Stewart.
Yeah, there are several great companies, and I'm a CPA. I can't tell you how many times I've argued with a CPA on the benefits of cost segregation, and I don't even understand why they don't see it. There's only one downside to it. It is if you do it, you take all that depreciation and then you flip the asset in the next 5 years. All of that comes back to you as recapture, which only means it's ordinary income, not capital gain. And yeah, that's a little bit of a bummer. I mean, you still sold the asset for a great price. I don't really understand why they fight against it, and CPA firms were the perfect ones to take that mantle and make it a business. A bunch of CPAs have spun out and created their own firms that do this, and we work with a couple that do a great job of it. And again, it's all completely above board. I was actually doing cost segregations in 2004 when it was the Wild West, and you never knew what you. And then the IRS capitulated and said, "Yeah, I guess it's right," because it's all based upon stuff that's been in the code since the '60s. So, I don't want to get too technical, but
Sure,
definitely look into it. It's well worth a look, and it's
yeah.
really
Do
not that
your
expensive.
research. We wanted to touch on it here and I just wanted to highlight it because I've seen it myself. So if you don't understand it, don't worry about it. You don't have to understand it. There's people out there that can, but now you can ask the right question. Are we going to cost segregate this property? And if they tell you no, then you ask why. And then you say, well, I've heard things about that. And you can do enough research to be able to find that's available to you. We're going to take a short commercial break. We'll be right back. And now back to the show. Well, that's some great information that you gave with tax benefits. Now I think we have to go to really the question of why should real estate, we've talked about some of the tax benefits of that. Why should that real estate be some of those core holdings in everyone's portfolio to your belief? And I'll be honest, I believe that too. So I'll say from my belief also.
Yeah, I'd say I sort of came to this conviction, honestly. When I was a young man, I thought investing was buying the next great IPO, and I came to understand that my belief of investing was really trading, and which is what a lot of people think, and frankly, it's what the financial media seems to promote. And then as I got older, and then I read more, and it's like, how do you really build wealth long term? Because I guess it's not going to happen for me overnight. And so, how do you build? So you have to take a much more long term view. And then, as you study building a portfolio, you want the first parts of your portfolio, the foundation, to be stable assets. And the most stable assets is real estate. I have a little thing that I talk about. I get angry with Wall Street because they've got real estate over offside in this little bucket with art and crypto and whatever that they call alternative assets. And it's like, real estate is not alternative. It's the original asset, dating back to the beginning of time. And they're not making any more of it, so it's likely to go up in value every year. In general, there's always going to be some problem, but anything that's cash flowing. Now, you could argue that there are some dividend paying stocks that would have a good place in your portfolio as a foundation, but anything that's cash flow generating is by definition more stable. It's throwing off cash because it's stable. And just a lot of other asset classes don't do that. So that's why I believe it has a place. Now, once you've got a good foundation and you've got excess availability in your by all means, go buy some speculative land. Go buy the next IPO. I mean, the foundation gives you the permission to go get a little crazy, just a little bit, and that's where you can have a little fun with your portfolio.
Yeah, I agree. I think it's something that's so important because again, you think about stocks when they tell you about that, what do? They tell you about dollar cost averaging and build in over time. Well, what are you doing with real estate? You don't have to buy 10 properties time. Don't get over your skis. I'm not a believer
Right,
in that at all. And I know you're
right.
not either, in where you're leveraged to the hill. But the thing is, you buy your first property. I told you I bought my first property in 94. Happened to buy a second one in 95 because we were moving and we wanted to live in it. So we was moving away. So we bought that second one. We kept the first one. And then we didn't buy another one for about 10 years. That's one that I look back and now I say that was a mistake I made, but you live and learn. But the thing is, then I continued buying and that became that investment property that's there and really became the difference. And I think that's the key you've got to look at. You're looking at a long-term play. Real estate, you can maybe buy something and maybe it grows in value. Maybe you sell it in 5 years to upgrade your property and you're able to exchange it, one of those tax-free exchanges you said. So it gives you opportunities. That becomes the real key. Now, I think a key question people are asking because, there's different real estate to invest in. And one of them that people are a little bit worried about, and I'd love to get your take on this, is sometimes why are office buildings not dead in your belief? And why do you think now is really a great time to still buy office buildings?
Um, just so you know, I practice what I preach.
Yep.
I've got 3 office buildings, and they're all full. Here's it's a bit of a semantical beef, and again, I'm going to pick on the financial media in that they say office is in trouble, office is dead. Well, come on, guys. Office is made up of about 6 different subclasses, and what's really in trouble? Downtown central business district office
Mm,
buildings
yeah.
and or class A office buildings. These are places where businesses typically don't see their customers, and they are gathering places for their employees to come and work, under the old world before, the pandemic. And those are the places that the employees are pushing back um, to that they don't want to go to anymore. Well, right now it seems like the employers are winning that struggle, but there's still going to be pain in a lot of, I think, largely blue cities that in these downtown central business district places. What are the other subcategories? There's what I call suburban office. Other people call service retail. I have one of those in Spring Hill, Tennessee. It's been full before the pandemic. It's full now. It was throughout the pandemic, and it's filled with doctors and dentists and state farm agents and mortgage companies and other kind of stuff. We're nowhere near any kind of a downtown or business district center. It's just sort of your average neighborhood building, and almost every single one of those people have to have a physical office. There's medical office, which I absolutely adore. I love I love doctors and medical professionals. They tend to not be price sensitive. They love these nice long 10 or 15 year leases, and yeah, and once you get them in, which that's where the battle is. Once you get them in, it's mailbox money at that point, and medical office is not in jeopardy because your doctor's not coming to see you and he's not going remote. He has to have a big place to keep that MRI and that ultrasound machine, and so they have to have an office. There's all kinds of other specialty offices. Right now, I'm sitting in Huntsville, Alabama, which is a booming city, and there's a whole section of town where most of the office space is, probably 3 million square feet of office space. that's all housed by defense contractors. And all throughout the pandemic, when everybody was staying at home, they couldn't, because every single one of those office buildings, and usually on every floor, they have what's called a skiff, which is a top secret room that they all have to go do their work in. They can't take their cell phones, and you can't have a skiff at home. And so that's actually Class A office space that's doing great. It's highly localized. I get that. But all of this stuff, and I hate the generalities of office is dead. Everything is local, folks. Everything is local. And know your market and know who the tenants are in there, and then you can make good decisions. So that's my 2 cents.
Yeah, I think that's a great advice, is because it's really about knowing your market, or finding someone that you're comfortable with, but know what you're getting into. And like you said, you're not buying one of the buildings that's, 1 million square feet and trying to do that. You're trying to find something like you're talking about that is long-term leases, people that, I like how you said that. Really, it's where they have to have people come in. And that's
Yep.
still going to happen today. It's going to happen tomorrow. It's going to happen 5 years from now. And some people say, well, telehealth. Well, they may have less come to the office, but guess what they're going to need? They're still going to have some place that they associate, because there are going to be times that people will need to come in. So do your research in those different areas. And that becomes a real key. We're not talking about, property that's so large. I mean, that it's one of those downtown areas, like you said, that, they was bringing everybody in, that today they're not. And I think the
Yeah.
key is really with real estate is knowing your options and doing a little bit of research, doing your homework, finding someone that's going to help you in that area. That's one thing. I was looking at your all's website, harvardgracecapital.com. They have a great website where they share some of the information, have some blogs on there, some great information for you to learn. Because if this is your first venture, you go smaller, but then you build up. But I'm also a believer, because we got small business people here, is you take part of your profits, and I believe in, you create an investment account that you put money into. You're still gonna have to pay taxes on it, but then when the time's right and you find a piece of property, then you can invest in that. If it's got 50,000, 100,000, and you've got your down payment that's there. So my last question I'd like to ask you, Stewart, because I know people are thinking this now, because the challenge is interest rates have went up. So it costs more to borrow on that money to have those dollars, but I still know there's good opportunities out there. And what would you tell someone that they say, well, I'm going to wait till the interest rates drop?
I would ask them to rethink that.
Yeah.
Right now, and again, reemphasize, everything's local. And in the markets that I follow and active in, we are now at what's a balanced market, sort of a balance between buyers and sellers. A year ago, that was not the case. And last year was a horrible year for deal flow. I like to say that I don't care what the interest rates are, because you make your money on the buy. And if I can, factoring in what interest rates are, and they're pretty much a given. Now, they will vary from institution to institution, but if you factor that in, then you back into the price that you're willing to pay to generate the cash flow that you think is fair for your investment, assuming it's a stabilized property and it's going to cash flow from day one. So to me, and again, I'm a numbers geek, I'm looking for a spread between the cap rate and the interest rate. And the cap rate is nothing more than a representation of the price you're paying as it relates to the income that the property throws off. So that's what you're looking for, is you really don't care what the interest rate is. Now, buying activity is down now, which means there are fewer buyers in the market, which makes the sellers a little bit more desperate. So if you're thinking about buying, get out there now, because don't wait for the interest rates. The interest rates will always be there. If you buy now, you can refinance in 2 years, and then you're golden. Because if the property works at 8.5 and 9, it's going to work exceptionally well at 6.5. Yeah. And so, but yeah, I guess, quote Warren Buffett, be greedy when everybody's afraid. And there's a lot of people that are afraid right now. And depending upon the markets that you're in, there's probably some steals out there. I'm not seeing steals where I am because it's a very healthy local market, and that's okay. I like I like a balanced market, but the best time to buy real estate is 5 years ago, and what's the next best time? Today.
That's great advice, Stuart. I really appreciate you sharing that because I'm a believer too, because I do think there are some places you got to know your markets, like you said, but there are some bargains out there because there's some people that want to get out of that real estate. Now you got to make sure, well, like we talked about earlier, it's got to be the right real estate that you're getting into, and you know your market, of what is available. I was telling you some of the things on the website. One of the things that really caught my eye is you have why real estate. And here's some reasons that they have on the website: diversification, passive income. We've talked about those. Tax benefits. We've talked about those. We didn't really get into inflation hedge, but basically think about that as inflation. I can tell you with the properties I have, it's been very beneficial. The inflation, I don't like it no more than anyone else. But you know what happens? My properties, they grew at a faster rate over the last couple of years than they did the previous 5. And then you can have professional management. So it can be truly mailbox money that Stuart says. You don't have to be the one taking care of that property that's available to you. So I'd really tell you, check out if you want to get some resources, if you want to reach out to him. That's the reason he's on this podcast, not to just educate us, but if you have some questions and stuff, I know Stuart will make himself available. And just go to harvardgracecapital.com and check that out. They do have some free resources on their website. The anatomy of syndication, a 7-step illustration that he has up there. So you can check that out. It's on the website. He's on LinkedIn. They're on Facebook. So you can check all those. We'll have all that in show notes because I know our people are not where they can write. They're going to have to look back at our show notes. We put all that information in show notes to make it easy for them. Anything before we wrap up? I got one more question for you before we do, but anything that you want to share that maybe you haven't been able to share yet, Stuart?
I just, as I said, I'm a CPA and I've worked with small business owners for 35 years, and I'm entrepreneurial myself. I just got a real passion for helping entrepreneurs and business owners um, take their financial future, where it's not completely locked into that business that they're running. And so Gary's talked about this several times. Set up a business account, and maybe you do one investment or one property a year, maybe one every 2 years. Just, the point is to just start because you need to be allocating income or be able to generate income outside of your day-to-day business. That's critical to your financial future.
Yeah, that's great information. Thanks for sharing that. Now, before I let you go, I'm going to ask you, what's your best advice you would give to business owners?
As sort of told you who I am, entrepreneurial and a consummate multitasker. But 2 years ago, a life-changing book for me, recommended by a friend, was "Who, Not How" by Dan Sullivan. And I've heard my entire adult life, you need to learn to delegate. A good manager learns to delegate. Delegate. And I guess this book just rang true with me. For one, it's not very long, and it's just when you're thinking about the next thing to do in your business, you as the CEO, you don't focus on how to do it. You need to focus on who's going to go do that task because you can't do everything. And when you keep doing that way, ultimately you lose your joy of running your business, and your business starts to drive you crazy. But it's the power of delegation, which is very difficult for some of us because that means you have to trust somebody. But read that book. I think it might become life changing for you.
Great recommendation and great advice there, because if you learn how to delegate, you're going to get farther faster and you're going to really get to the pot of gold that we talked about at the very beginning of this podcast that you want to get to. Again, check out Stewart and M's website, harvardgracecapital.com. All the social media channels are in show notes, so please check that out. I always give an action item after this. This is an area that I think people can tell I'm excited about. I love sharing with people. I feel very fortunate. I'll be honest. I got into investment income, properties in kind of the backdoor way, but sometimes that's the way you have to get there. But now you're hearing about it. So my action item would be diversification. You're a small business owner. So from the very get-go, how can you start diversifying your income? You have to decide what it is. We believe, Stewart and I believe, property should be one of those. Real estate should be one of those investments. But that's up to you. We can't tell you what to do. But the only thing I would tell you is start researching and decide what you want that diversification to be. Because like I said, I don't want you to get to the end of the rainbow and there's nothing in that pot of gold for you, because we don't know what's going to happen with our business. Plus, what it does, it allows you to generate other income. And that's what's so important. So it's great to have you on the podcast, Stewart. Great topic for our business owners to be thinking about. And even if you're thinking, oh, things are high now, interest rates are high, hopefully we've misspelled some of those myths that now you need to be thinking about that, because this could be your opportunity to buy them at a lot better rate than you did before. Thanks again for joining us today, Stewart.
Thank you for having me. It's been fun.
Listeners, all I'm going to do, I gave you the action item already. Please like and share this. If you know someone this would be beneficial for you, I know you know someone else in business, please share this over. Go to your app on your phone. There's a little share button. All you got to do is put in their phone number. Actually, you probably have them in your contacts, and just share it. It'll pop up on their text message, and they'll be able to listen to this podcast and get what they need out of it also. Again, if you can let others know about our podcast, we keep growing each week because you're sharing this and letting others know about it. Thanks for joining us again this week, and make it a great day.
That's all the time we have for this week. To continue your journey, head over to smallbusinessanswerman.biz to access the tools and resources mentioned in today's show. If you enjoyed this episode, please subscribe and share it with someone who would benefit from listening. That's smallbusinessanswerman.biz. Until next time, remember, when you find the right solutions, your business grows and you get your time back.